Hello, Michael Litt. How are you today, man?
Good, Stephen. Good morning. Good to
Well, if
see you
y'all don't
again.
know, that's right. If you don't know who Michael Litt is, I want to post it right now. He is the global investment strategist. I think he is the man for the stars. When you talk about investment advisors out there, people turn to Michael Litt. For those of you who don't know, he's at Front Point. A lot of places that you just know about, and I want to get right into it, Michael. There's so much going on in the world right now, and you've just published a new paper about all of this, and I think you did an outline saying, where have all the exits gone? So tell me a little bit about what you just posted.
Right. So, where have all the exits gone is a structural piece about equity markets and global financial markets generally. And the question is, where have all the exits from the private equity, growth capital, and venture capital funds gone? Because we have seen a decline in return of liquidations, exit transactions for those funds, and return of capital, which is referred to as DPI in private equity circles. And it's running at about a third of, depending on the fund, but on average, about a third of what it has historically gone. And we have a chart that kind of shows this. And over the last 10 years, the amount of total investments in private investments has grown to $4 trillion, and which is about roughly 10% of the market cap of the S&P 500. And you can see how quickly it's grown, and you can see how much of that, fully half of it, has occurred over the past 5 years from 2019. The gray is just the new money that has been invested. Meanwhile, the teal blue bars at the bottom are the amount of exit capital coming out. And you can see that over the last decade, the amount that's come out in 23 and 24 is kind of about the average for that last decade, 341 and 339 million. But as a percentage of the overall monies invested, you've now dropped down to sort of 7, 8, 9%, sub 10% harvesting, right? Whereas previously you had ratios of 25 to 30% harvesting on an annual basis. So limited partners are seeing a return of capital on a much, much slower basis. The market believes, people in the market say, oh, this is just because interest rates went up and it will return to normal as soon as interest rates go back down. And I did a lot of research on this, and where have all the exits gone is essentially covering that it's not just interest rates. There's a whole bunch of structural factors that are at play, and this is actually the new normal. Now, that has a lot of implications for public markets as well, and that's what we're going to dive into today, Stephen.
And you have to ask the question. I mean, you just said interest rates, but does this also, because you're looking at those years of COVID too as well, right? Was there COVID money coming in?
You know, it's interesting you say that. COVID was a chapter in this story, right? But it was the peak of the private equity and venture capital growth investing cycle was in September of 2021. It ended September of 2021, which was well into COVID. The reason that I believe both that, and Blackstone had set up an entire unit called Blackstone Growth, and they were going to buy growth companies as opposed to the old traditional leverage buyout of, metal bending type businesses. And that was the big initiative. They did the Oakley deal, they did the Bumble deal, they did a whole bunch of growth-oriented things. There was a real surge of capital, large amounts of capital into growth-oriented investments from private equity, venture capital, and growth capital following on its heels. The reason that I believe it had surged was that we did not in the 2010s, we really didn't have a significant recession, meaning the recovery from the great financial crisis was such a slow burn that we didn't have a big recession. Nominal and real interest rates were low, so capital was cheap. Credit spreads were tight. And there was increasingly, as you got into 2018, 19, 20, there was an overestimation of growth opportunities, and the valuations reflected that. So that everything, a peak in valuations for any segment of the market is always set up by the conditions that lead up to it. Those were the conditions that led up to what I would call a very high equity risk premium, which beginning in September 2021 began to decline. Now, this chart shows the equity risk premium over time. In the equity risk premium, like if you have a credit spread, your base rate is treasuries, and then you get, for taking higher credit risk, you get more spread.
Mm-hmm.
The equity risk premium is the same concept. The expected return on equities based on the valuation of equities, their projected earnings, and current interest rates implies an equity risk premium above base treasury rates. Use the 10-year rate in your mind. When markets feel very good, like they did just before GFC, you get a very high 6.5% risk premium spread. There were times when interest rates were very low where the equity risk premium was high, but it was consistently high, changing a bit from 2010 to 2021. And it peaked again in 2021, the most recent peak at 6%. But what has happened since then, it has declined. And it is now actually even lower than is shown on this chart. And this is for the S&P 500, which includes the mega caps. So you are now down at a post-dot-com collapse equity risk premium. When you remove the 7 mega cap stocks, the S&P 493, the S&P 400, and the S&P 600 are exhibiting even lower equity risk premiums. And the equity risk premium reflects confidence in growth, right? So people think the markets are at all-time high and they're overvalued. We're having a momentary transition from tech being a leadership, and some cryptos getting hit. A lot of that stuff is getting hit, but and we're going to touch on all this later. But nobody is talking about the fact that the equity risk premium is now at 25-year lows. Okay, and it's especially so for the S&P 493 and the mid and small cap stocks. So that is having a huge impact on the ability for private equity to exit its existing investments, because they don't own mega cap stocks. They own small mid cap companies. They own the lower end of the S&P 493. The valuations for those, because the equity risk premium has collapsed, is low. And a little bit of the reason for that, and it's especially low for those smaller mid-cap companies, part of this is due to indexation. And indexation has become a behavioral factor in the marketplace that's become very important. And I knew years ago this was eventually going to play itself out.
Is this because of algorithms? Is it because of more people saying, I don't really want to invest in individual stocks, I would rather just invest into ETFs and indices?
Indexation is tax efficient.
Right.
That's part of the argument. Indexation, people can't, the record for people picking stocks against the index has not been great.
Right.
Rational. But there's a mathematical and structural factor underlying it, that the supply and demand of securities at the margin, okay, is not necessarily reflective of the market cap of a company. So what happens over time is indexation drives you to a winner takes all, meaning the valuations for the mega cap stocks get driven up because every dollar that comes into an index fund tries to buy more and more and more. And so you get almost a logarithmic ascension of the percentage of the market cap. It's a self-fulfilling prophecy. So the money coming in keeps driving those stocks up higher and higher and higher, and people believe they're worth that amount. Now, the last time this happened in markets was during the Nifty 50 era, when everybody owned the Nifty 50 stocks. And I point this out in the paper. And what everybody knew, every trust officer on the planet knew, that you had to own those stocks, right? That's the stocks you just bought, right? And essentially, when you buy the S&P 500, 25 to 30 cents of every dollar goes into the 7 stocks. That's essentially what's happening. It's happening through a different conduit. It's happening through the indexation. And active managers try to mimic the index so they don't get fired. So they essentially have to respect the index and buy a lot of those stocks, maybe even overweight them. What that does is it drives the valuations up, and it represses the valuation or the growth risk premium on the rest of the stocks in the index. What happened once the Nifty 50 peaked, only one of the Nifty 50 stocks outperformed the S&P in the subsequent decade. One.
And can you remind everybody why it was running to the Nifty 50?
Because Polaroid, Xerox, IBM, they were going to own the world. They had the technologies, and nobody else had the technologies. They had the lowest cost of capital. Nobody else could compete with them. Right.
And speaking of low cost of capital, are we seeing that? I mean, fairly, in considering the rest of the world and the rest of the time frame, and now, I mean, rates of 10 years at 4.457%. We're still pretty low rates considering globally and considering time wise here. But I think one of the points you made here is that IPOs and M&A activity has also been subdued.
Well, that's right, and I think the low risk premium makes the IPO markets less attractive. Now, remember, index money doesn't participate in IPOs, Stephen. Right?
That's right.
Take that all off the field. Active managers have become reticent to participate in IPOs unless the valuations are very attractive. Think low equity risk premium. That doesn't favor high IRRs and high valuations for private equity exits, right? Yeah. In fact, you're not even seeing a lot of corporate spinoffs in this environment. Same reason. So what's happened is all of those other stocks and the market itself has become a value play on a medium and long-term basis. There's value in the markets away from the mega cap stocks. By the way, the only stock that outperformed in that subsequent decade after the Nifty 50 peak was Walmart. Yep. And that's because its growth was so high, it was able to overcome a ridiculously high valuation.
Right.
But you have to sustain ridiculously high growth to justify those very high 30 and 40 and 50 PEs. You see what I'm saying?
Yep.
And only one company was able to sustain that growth.
And then I think a lot of people understand Walmart being the growth was international, not just here in the United States too. As well.
It was. I mean, Walmart was on, and they put Sears out of business.
It sure did. Yes.
Right. So let's talk about cost of capital. You're right. In my earlier research paper, we talked about the direction of travel. I felt that 4 to 5% was where the 10-year was going to trade, and the reason was that we were going to settle in the mid twos on inflation, maybe 2.5, 2.7, and yet you were going to have a 200 basis point real cost of capital on treasuries. New administration, new set of things. I don't want to get into that today. I still think that's a legitimate place. There are other dynamics at play. We'll talk about that in the summertime. But when I read another research paper, the cost of capital for corporations has gone up because of bank regulation. Bank regulation has driven banks out of lending because of the regulatory capital they have to hold against loan books. So two things have happened. One is private credit has risen rapidly to replace bank lending.
Yeah.
Limited partners in private credit funds demand higher returns than does a bank. And the reason is because private credit funds are nowhere near as levered as a bank. So a bank can take a lower spread against their lower cost of funds, lever it up, and companies can borrow at 7% from a bank. Right?
Now, without getting too deep into it, I know you don't want to, you said it's summertime, but with the new administration, are you going to start to see lower bank regulations?
You have to get to a lot of regulatory. I mean, we maybe set us up to repeat the great financial crisis. Could be.
Yeah.
I don't think that's what they're going after.
You think it's not changing the laws, but it's lowering the number of regulators.
I think the bank regulation and the sanctity of the banking system is not going to be unraveled as part of what we talk about. That's not the first order of regulatory change. So a private credit fund wants to, on a gross basis, get 12%, and then the investors are going to get 9 to 10% net, and that satisfies limited partners. Whereas the bank could lend the money at 7%. So you have about a 400 to 500 basis points increase in cost of capital. That transfers wealth from equity holders to debt holders.
Right.
That's the avenue through which the U.S. economy and corporations are experiencing this cost, and it's creating a new industry, a growth industry, private credit. Now, without private credit, the capital wouldn't be available. So let's be clear. Private credit is doing the economy a service. But a levered banking system was in fact providing capital cheaper to the corporate system and equity holders who benefited from that cheap borrow, or that cheaper, less costly borrowing. You do transfer wealth. So part of the reason that you see a lower equity risk premium is because of this structural factor created by bank regulation and the increase in private credit. Now, banks are keeping loans on their balance sheet, but they're selling off the first 10% of loss in what's called an SRT, significant risk transfer sale. So they sell the first 10% of loss off their books. They get 80% relief on regulatory cap for that, Stephen. But they have to sell it off at a discount that raises what they have to put loans out at. So even for the banks, they're going to have to raise what they lend at to pay for that SRT sale. So structurally, what we're seeing is higher cost of debt capital because of bank regulation. That's one impact. Indexation, as we talked about, is another impact. No participation in IPOs for index monies, risk aversion on the part of active managers to veer from it, and they're less aggressive on what they'll pay for an IPO. So you see how this is setting up, where these mid-cap and small-cap issues that private credit owns are too cheap. They're low price. So what private equity is doing is you're seeing a rise of secondary funds and continuation vehicles where they're extending the duration of private asset holdings. Private assets are becoming a larger portion of pension plans, sovereign wealth fund, endowment. Even the wealth channel is increasing its exposure. The reason they are is because private equity has delivered slightly higher returns than have public markets over the last 2 decades.
And I think one of the points you made was for the ability for private equity firms to attract that top management in order to get that money too, is right?
Yeah, I talked to one of the top senior management at one of the top 3 recruiters in the world. Yeah. And we were at a dinner and I had a chance to really dig into this. They have to remain nameless. And the reason is because, they work for both private credit and public, but it's getting more difficult to recruit top management talent to public companies because of the reporting requirements, the D&O exposure, the quarterly conveyor belt of reporting. In fact, Nordstrom's said, we cannot manage our business to a quarterly target. We need longer time horizons to make good investments. They took Nordstrom's private again for that reason, Stephen.
Yeah.
Private equity can be more generous with equity incentives for management teams they're bringing over. Private equity is not always easy to work with, as this senior head of a large recruiting firm told me, because there's a lot of egos involved in private equity. But public market boards and being a public market CEO can be even more difficult, right? So I'm not saying it's a nirvana to be a CEO at a private equity firm, but the incentive packages that can be offered and the potential for slightly lower bureaucracy are on balance making those jobs a little more attractive and a little bit easier to recruit people, and they are recruiting people away from public companies, right?
So do you think that that there's a major growth in private entities not wanting to go public? I think you made that point, right? That some of the legal costs are also making it an issue too.
There are some structural. Yes, but I think if valuation were there, if we went back to 6% equity risk premiums, private equity has a contractual. The difference between a private family business and a private equity firm is the private equity firm sponsor has an obligation to liquidate and either take that company public or sell it to somebody else, right? That's how private equity differs from a family-owned business.
Right.
There is a contractual obligation to sell or liquidate or exit that investment over some time horizon, right? Within a decade, let's say. Now, private equity holdings have reached their longest duration at the end of 2024, meaning private equity investments have never been held this long. And what I'm saying is, unless these factors we're discussing here change, valuations and equity risk premiums in the small mid-cap come up, IPO market multiples come up. It's not just interest rates. Interest rates is what people believe it is. It's all these other factors that are contributing to it. I don't think that the inhibition to become a public company is so great that it would impact private equity taking the companies public as their exit strategy. In fact, I think that's what they run to do, Stephen.
Right.
But there were 8,000 publicly held traded companies in the U.S. In 2000. There are now 4,500.
Right.
Okay. So and the cost of being public, the exposure, the attracting good management are just incremental factors, I think, that have benefited private equity and its ability to generate 100 to 175 basis point return above the public equity markets. The question going forward is, will that be sustained at this scale? You would imagine that it would come down, but I would put the outperformance that I see happening in these lower valued, lower equity risk premium away from the mega caps would be shared by private equity, meaning they would, as the S&P 400, 500, S&P 493 risk premiums recover, which they will, private equity returns will also recover with them. They're correlated with those assets. Those are the cheap assets. That's where the value hunting for a medium and long-term investor is. Not a trader. I don't advise traders. I advise sovereign wealth funds and large private equity or large investment funds. Right. So I'm always thinking medium and long term. But that's
let's think medium and long term. Let's think medium and long term. I mean, the president of the United States has now said he wants to have a United States sovereign wealth fund. I take it you're for that.
Well, a funded 83% of unfortunately, the Doge is whittling away at 17% of the deficit, right? The discretionary, we've talked about the discretionary budget. You could lay off everybody at TSA and, we wouldn't, we'd all be taking the bus, but it ain't going to move the needle, Stephen. We've got a baby boomer demographic, and we have transfer payments for Medicare, Medicaid, and Social Security that are the big enchilada, right? The only way you can deal with that is like a Simpson-Bowles or Greenspan 1983 commission modification, which should acknowledge the fact that we're all living longer, we're working longer. People in Japan Japan's 15 years ahead of us. They're working longer in Japan. We're starting to work longer. We're living longer, right?
Right.
We probably do need means testing for getting those transfer payments, right? We probably do need that. The idea of the sovereign wealth fund, I think, is to have a funded pension scheme that isn't a pay-as-you-go system. So, yeah, I think a lot of this is the this experiment, which my next research paper that I've started outlining is called the Great Deconstruction, which is this deconstruction that they're doing. I'm not sure there's actually even a plan. I think they're just shooting and then aiming and then thinking in that order.
And with that thought, is that affecting the interest rates? Because it seems that the bond market seems a little bit uneasy right now.
Uneasy in the sense that the economy appears to be slowing.
Correct. Yeah.
You're getting mixed signals. The economy, if you look at the Philadelphia index, the CEO surveys, investment intentions, yes. Now, Walmart sales remember, that's the lowest 2 quintiles, meaning the lowest 2 1/5 of the consumer. And they have disassociated. Their cycle has more and more disassociated from the larger economy. I hate to say it, but it's because the wealth gap is larger.
But the numbers for the hiring in construction are the lowest in 2 decades here. And for me, it felt like that the president coming in said he wanted to turn this country back into manufacturing. He wanted to build again, fix the roads. He came in with the big promises, and his big win right now seems to be Doge and cleaning up some of the excesses of the government, which is great, but it won't put a dent, as you said.
The question is, are you fired? Do you even know if you're firing the right people? Have you thought about this? Ted, do you have show me the plan?
Right. There's no plan.
Shoot, aim, think in that order.
Right. But with construction hiring at the lowest it's been in 2 decades, that worries me probably more than anything. And these new numbers of consumer sentiment coming out that are really low contractually now, and also with services PMI this morning again coming down. It seemed like there's an overwhelming feel of malaise in the markets, feeling well of malaise in CEOs, and they're not willing to hire. They're not willing to do all of these things. And is that why these top managers are leaving these public companies and going to private equity as well?
No, that one's a short-term phenomenon, and the other one's more of a structural long-term phenomenon. So that's not related. The two aren't related. It's an interesting conjecture point. I would say that the CEO investment intentions are still pretty strong, and the economy appears to be. The tariff, I wrote in this paper, I did a sidebar about the new administration, about Scott Bessent. And I still think the most dangerous thing that this administration could do is seize the independence of the Fed. Because the last time that happened, we had the 1960s, 70s runaway inflation.
Right.
Okay, so that's the biggest risk, let's be clear. The tariffs and, sidling up with a failed economy like Russia and spurning the other large trade partners in the world is dangerous. Global trade is about 10% of US GDP. So it's roughly 30 billion and 30 trillion and 3.3 trillion. So at the margin, and you're not going to collect this notion you're going to collect a bunch of taxes from tariffs is bogus. I think we collect $25 billion in taxes from steel, right? You might, I saw a headline the other day, the Doge has already cut $3 billion or $3.9 billion in spending. If you had a clock, do you realize how fast the U.S. government spends $3.9 billion?
Yes, I actually do know. It's less than 11 minutes.
From when I started that sentence to when I finished that sentence.
Right. It's less than 11 seconds. Yes, correct.
Okay.
Yes.
So again, we're going after crumbs on the floor, right? These are not big, impactful things. They probably would play well to a MAGA crowd at a rally, and everyone would cheer in Enid, Oklahoma. But the truth of the matter is it's not moving the needle in the real world. The tariffs could slow trade. It could slow confidence. It could, but the biggest thing about the Great Deconstruction is it creates uncertainty, because we don't know if what the plan is, or even if there's a plan. Actions are being taken that are going to increasingly have impact on everybody's decision making. And economics is ultimately a behavioral science, right?
Right.
So the Great Deconstruction may inflict hesitation and uncertainty on microeconomic factors that will slow what appears to have been going into the new administration an accelerating economy. It could certainly slow that. And I think the risk to the Fed is the greatest one. Trade is the next one. But ultimately, what will dominate is the impact, the negative impact on economic behavior because of uncertainty, right?
And is that uncertainty?
Construction is a lot of change, and nobody knows what the plan is or if there is a plan.
Right, and then uncertainty.
That's not a political statement.
No, I understand. And you're looking at it. I'm looking at the gold price now, $29.30 now an ounce, U.S. dollars. Is that another reason? I mean, we're talking about where both Elon Musk and both President Trump are now talking about auditing the Fed, auditing the gold in Fort Knox. This is adding to a lot of that stress, I think, in the world.
Absolutely, yeah. And I think if you're somebody in Canada or in Greenland or in Ukraine or in continental Europe, in some ways, I said this in the research paper, the erratic behavior is meant to create a negotiating advantage, because your game theory as a negotiator with Trump is he may do something completely irrational and not in his own interest. So you have to factor that into your game theory when negotiating with him, which may on balance give him an advantage in the outcomes he's seeking in those negotiations, right? What is the cost of creating that level of uncertainty and erratic decision? What appears to be unplanned, I'm not going to use erratic, unplanned decision making, right? Like I would rather have them say, hey, let's resurrect Simpson Bowles and focus on getting an accelerated Simpson Bowles, maybe even make it even more cost savings than Simpson Bowles had proposed, because Simpson Bowles didn't get put into action. It would have helped us multiple trillions of dollars right now had it been implemented, right? But Congress couldn't agree. They didn't get him. If they said that, then I'd say, hey, they're going to save $2.5 trillion.
Yeah.
2 thumbs up, right? Laying off a bunch of TSA workers, maybe all of them aren't needed. Maybe you can automate some of that stuff. The guy he put in to run the post office, DeJoy, failed.
Right.
People think, oh, we're going to make all these changes and they're all going to succeed. Well, wait. DeJoy just resigned and it was a miserable failure, right? He didn't. Now, the post office could probably be improved, but the right person and the right plan was not implemented, right? It was the wrong CEO. I think that what people are missing in all of this, Stephen, is how much of this great deconstruction is going to be work. How is it a good plan? Is the plan going after the right stuff, right?
Well, let's talk about that. I mean, you mentioned Simpson's Bowl plan. For those of you who don't know, that was during the Obama administration, where they did some key things like raising Social Security retirement age and cutting some discretionary spending. I believe it was $1.7 trillion, not $30 billion, right?
And Alan Simpson, a Republican senator from Wyoming,
Correct.
was the key sponsor, right? It was during Obama, but it was championed by what called Simpson a moderate Republican, centrist.
Moderate Republican from Wyoming, and Erskine Bowles, obviously my old boss. But it targeted $4 trillion over 10 years and reduced the national debt as percent of the GDP. They also proposed 3 tax brackets, which was 8, 14, and 23, and they cut corporate tax rate from 35 to 26. I think some of those parts of that Trump is actually saying he wants to do, correct?
You hope, you know what I mean? If you said, okay, hey, here's the plan, right? And you've got a majority in Congress. So,
that's right.
You know what I mean? You could, and then you said, we've got a plan. We're taking Simpson Bowles, we're upgrading it for some things now. It's 10, 12 years on from when Simpson Bowles didn't get implemented. And I think you'd have I think gold would be lower. Yes. I think rates would be lower. Now, Scott Bessent can agree or disagree at the margin, but being a central banker, being the chairman of the Fed, it's not a science. There's a lot of exogenous factors and unpredictable elements. They got inflation I think there's a little bit of blaming inflation, COVID inflation and supply chain disruption on Jerome Powell. Mm-hmm. Did he wait a little too long? I agree with Bessent. He waited a little too long.
Yes. Well, we all do, I think.
But I don't think we should go back to the 1970s where the Fed loses its independence. And invariably, you end up with runaway inflation because that's what politicians do. We will shift one chair closer to a banana republic if the Fed loses its independence. That's bad for everything.
And I'm looking at the Project 2025 with their simplified tax brackets. They're saying they want to charge 15% for incomes up to Social Security wage base and 30% for higher incomes, but would eliminate most deductions, credits, and then corporate tax reduction would go from 21 to 18. So about 5% less than what even Simpson Bowles was saying for corporate tax.
But correct? It's along the same lines, and eliminating the deductions is a huge thing. As long as you don't get every real estate guy on the planet stickering his special treatment. You know what I mean? The problem, they start out with no deductions, and then what happens is deductions mount and mount and mount right. and mount. And there's no question that would, laying that plan out and that, but again, you have to do Project 2025 to the transfer payments. You can't just lower taxes without modifying the transfer payments because you balloon the deficit. Right. And it happened when he lowered taxes and didn't deal with the transfer payments in the first administration. Right. It generated $7.5 trillion of incremental debt. So you have to deal with both issues. And yeah, sure, you have to deal with Medicare and Medicaid fraud, for sure. We've got to bring more technology to that. We've got to deal with government agencies that are sloppy and wasteful. Yeah, but that's small compared to tax policy and the transfer payments, because that's 83% of the equation.
But the Fed says that they want to get us down to 2%. That's their mandate. And the 2025 is saying that they're proposing to remove the Federal Reserve's responsibility for full employment, concentrating solely on inflation control. They're taking advantage, and they want to take away some of that Fed independence.
Yeah, that's dangerous. And the dual mandate is a balanced mandate historically. I think what they're getting at is this: the problem the Fed is its own worst enemy.
Yeah,
The put option for market participants, right?
Yeah.
Lowering rates when markets go down. And there's some really good research papers that I've gone back and read on this topic. The Fed put itself in a bad position by reacting too quickly to market disruptions, as opposed to, and I think this is where the bank regulation comes in. They're trying to get the banking system stable enough that the Fed doesn't have to respond to market disruptions with policy initiatives, because that is like a third leg. It's not the employment, full employment objective that creates the issue. It's the supporting markets, Fed cutting rates and using its balance sheet to provide liquidity to support markets. That has become dangerous because it creates expectation and it creates irrational risk taking.
Yeah. Well, Michael Litt, dear friend of mine for many, many years now, global investment strategist to the stars of all of Wall Street. I want to say once again, thank you for having.
I don't have any clients that are stars. These people work in the bowels of the engine room at Global Asset Allocation.
You are. I mean, when it comes to sovereign wealth funds, they come talk to you. I love it.
Yeah, I don't know. Anyway. Stephen, good luck. I hope this helps. And again, the research paper is something that anybody who's in the markets should read, because it touches on every aspect of what's going on in the market structurally, right? It's, always step away a little for some of your time to structural issues from the day-to-day trading activity, because if you have the structural backdrop, you're going to make better decisions day to day in your investment decision making. I always tell people that.
And that paper is called "Where Have All the Exits Gone?" And we will post that as well into our Twitter. We will put it out there on LinkedIn as well, so you can have an access to that too as well. We give out the papers here. So, hey, Michael Litt, until next time, man. I'll see you later.
Be well, Steve.